Hey guys, how you doing? This story comes to us from Michael Ballinger. The gold to silver ratio, a truly generational opportunity. Are we starting a once in a generation opportunity here? This week's gong show in the global financial markets reminds me of the early 1980s before the advent of the internet or online trading or blogs, and especially before the 30-something financial advisors were allowed to go on the national and international airwaves on internet websites and babble on for what seems like days how the Fed has our back as an excuse for buying stocks at 23 times forward earnings. 23 times forward earnings. That doesn't tell you there's a bubble. I don't know what does. Back then, at 4:15 every Friday night, there would be a lineup of brokers and analysts, even a janitor next to the old teletype machine. I'm imagining more than a few raised eyebrows among the kids out there as they quickly Google search teletype machine on their smartphones while sipping a $10 cup of fancy ass coffee in expectation of the all-important money supply numbers that everyone supposed was going to give them a hint as to where interest rates would start to decline from 16 plus nosebleed levels to of the early 1980s. Today it is essentially the same, except that the teletype machine has been replaced by Janet Yellen, and the ribbon of paper giving us the money supply figures is now Janet Yellen's tongue giving us the all-important clues to the hawkish, dovish leanings of the U.S. Central Bank. However, one thing hasn't changed: the absolute lunacy of these obsessions and how the algo bots seize upon the world clouds and move markets trillions with every single utterance out of Janet Yellen's mouth. So gold and silver immediately vaulted higher along with stocks on Tuesday afternoon, after which every gold guru on the planet was emailing me about how I had best not fight the Fed, the risk of an anal impalement, and that because new, big, and smart money buying paper and physical gold would force the bullion banks to execute a managed retreat. My near-term caution was misplaced, but unwise and suicidal. So along comes Yellen and tells the world that basically she could care less about inflation. You know, the Fed's major 100-year mandate is to monitor inflation. And what should have been a $100 explosion in gold prices to $13.50 an ounce actually becomes a paltry $20 an ounce move to around $12.42 and ends up back below at $12.30 an ounce the very next day, a substantial $57 off the top since earlier in March. Today the US dollar index is down again, and while a weaker US dollar hasn't always been a clarion call for the gold bears, it certainly has provoked a tailwind of sorts for the gold bulls. The problem for me is that the GDX is not exactly lighting up the runway as a harbinger for a higher bullion price, and with gold up 550 at midday, New Mount Barrick, Gold Corp, and the HUI are all down. Was it not only 2 days ago that the Fed's Madame Yellen gave us all the green light for gold? Then why isn't it through 1300? For reasons that gold and silver are not screaming higher against the most bullish of fundamental backdrops is clear. The bullion bank traders are under orders to clip another $50 an ounce for their Q1 pals, and as we close out Q1 16, despite having Yet the best quarterly advice in over 25 years, it's still $50 off the highs. I stick to my guns. Gold must have a pullback that shakes out all the latecomers to the party and gives us all a healthier entry point. All those cynics out there who were skeptical back in December when I was pounding the table and doing a table dance on the City Hall steps after gone from bearish to bullish in a short 3 months because they only got in after the HUI skated up the ice over the 170 blue line and are now flat with momentum rolling over. They want the puck deep, but I say it gets dumped back into the neutral zone first while they head for the bench, sucking wind and hollering for Gatorade. Now, having got that off my chest, I was doing some work yesterday on the outlook for silver, and before I go on, there are some awfully bright people out there that know the silver market fundamentals a whale of a lot better than I do. Ted Butler, David Morgan, and Eric Sprott are three such people, and notwithstanding the fact that they are considered silver gurus, the work they will all do is exhaustive and has its roots purely in the data. A great many orators out there that have great skills in communicating the silver story are, with great respect to Marshall McLuhan, masters of the medium, whether it's by the pen or by podcast or by standing in front of crowds at investment conferences. But the type of research I have sought out for the past 40 years is the kind that has empirical data behind it. Footnotes and references and brackets that tell me where the hell the author got his information. I recently did an article by Jeff Nielsen. I recently read an article by Jeff Nielsen entitled Silver Fundamentals, The Numbers Don't Lie, in which the long-term case for silver made and as compelling as in my own scatterbrained, ad hoc, instinctive sense of silver being generational buying opportunity. This article throws all my gut feel type of maverick analysis off the 34th story balcony, and it sails gleefully through the air, sheets of pencil scratch paper being ripped to shreds. Having the occasion to see the numbers is really quite a revelation. You see, McLuhan inferred that because the form of the medium, oration, penmanship, blog, podcast, YouTube video, embeds itself in the message, silver is good, silver is bad. There is created a symbiosis of sorts by which the medium influences how the message is perceived. So when I read an article that is grounded in influences how the message is perceived, raw data, and contains information from as far back as 1344, is a form of educational enema where the purity of the message is unaltered by the colorization of the medium. In other words, fact replaces bullshit. Needless to say, despite my ongoing belief that we are now in a corrective phase for the precious metals, I think owning silver versus owning gold is a high probability trade that could be the 2016 trade of the year. I'm going to put on a trade this week that effectively favors silver over gold and is a high risk method of shorting the gold to silver ratio, whose chart I posted a few weeks back. If If I'm right about this pending correlation, or correction, excuse me, if I'm right about this pending correction in the metals, gold will get taken down harder than silver, all based on the gold to silver ratio. So I want to give myself enough time to cover the short in gold and double up on the silver long, so I will use the July options. I will buy 100 SLV July $15 calls for 68 cents, US $6,800, and also 20 GLD July 115 puts for $2.92, US $5,840, for a net debit of $12,640. I will need to see either 108.68 on the GLD or 16.26 on the SLV as a break-even point on this trade by the third Friday in July. By engaging these long positions, I'm effectively shorting the gold to silver ratio, but will need to see this narrow seesaw back and forth trading range of the past 4 weeks dissipate, and do so quickly, lest the time premiums erode away to zero. The risk in this trade is that we see a continued range for gold and silver above 1160 to 1170 for gold and under $16 to 16.25 for silver, right through July, at which point both options are worth zero, and I'm seen chasing my dog around the house with a bottle of Jack Daniels in one hand and a pair of vice grips for the medicine chest in the house with the other hand, playing Zeppelin's Kashmir at max volumes. Let us pray for otherwise. Crazy bastard. Anyways, guys, I hope you found that amusing. Keep stacking. Take care.